The battle for your wealth. The U.S. national debt is sprinting past $34 trillion. Inflation may be cooling, but the damage is already done. For the average American family, the cost of living is permanently higher. And the U.S. dollar, the world's reserve currency, is under pressure like never before. In moments like this, smart money doesn't sit still earning 0.01% in a savings account. Smart money runs for cover. It looks for a store of value. For over 5,000 years, that cover has been gold. No software updates, no servers, no promises. Just scarcity, trust, and time. Gold is the undisputed heavyweight champion of wealth preservation. But over the last 15 years, a digital challenger has stepped into the ring. Bitcoin. It's faster, scarce by code, and it has delivered returns that make Wall Street blush. Today, we're not just staring at charts. We're diving deep into the American battleground. The Federal Reserve, the SEC taxes, and the macro endgame. If you're holding US dollars and wondering where to park your wealth for the next decade, this may be the most important 15 minutes you watch all year. Let's enter the ring. Gold, the indestructible incumbent. Let's start with the reigning champion, gold. Why do humans value this yellow metal? It's simple. Gold is chemically indestructible. You can melt it, bury it for 1,000 years, dig it back up, and it's still gold. It's scarce, painfully hard to mine, and recognized everywhere on Earth. In the American context, gold is the ultimate hedge against the Federal Reserve. Since the Fed was created in 1913, the US dollar has lost roughly 97% of its purchasing power. Gold, over that same long horizon, has held its ground. No bailouts, no promises, just time-tested preservation. When Nixon took the US completely off the gold standard in 1971, the leash came off money printing. Gold was fixed at $35 an ounce. Today, it's over $2,000. That's not speculation. That's monetary reality. Gold is the fear trade. When Russia invades Ukraine, when banks like Silicon Valley Bank collapse, when trust in institutions breaks, people don't buy promises. They buy gold. It has zero counterparty risk. If you hold physical gold, you don't need a bank, you don't need the internet, and you don't need a government's permission to own it. In moments of chaos, gold doesn't ask questions. It just survives. Key U.S. insight. Now look at what central banks are doing. In 2023 and 2024, global central banks bought gold at near record levels. These aren't emotional traders. They don't chase headlines. They plan in decades, not quarters. And right now, they're diversifying away from U.S. treasuries and into hard assets. That tells you something. If the world's largest banks, the ultimate insiders of the monetary system, are buying gold to protect themselves against dollar uncertainty, then the real question is, shouldn't you at least consider it? The downside. Let's be honest about gold. It's boring. It doesn't generate cash flow, and it actually costs money to store securely. In a raging bull market, like we saw with tech stocks, gold will severely underperform. It won't make headlines. It won't 10 times. And it won't make you rich overnight. Because gold isn't for getting rich. It's for staying rich. It's insurance. And like all insurance, you only appreciate it when things go wrong. Bitcoin, the digital revolution. Now comes the challenger, Bitcoin, often called digital gold. But Bitcoin's scarcity isn't geological. It's mathematical. Gold is rare because the earth made it that way. Bitcoin is rare because code enforces it. There will only ever be 21 million Bitcoin. No exceptions, no revisions, no emergency printing, no central banker, No president, no CEO can create more. In a world where fiat money is printed endlessly, absolute scarcity isn't just different. It's revolutionary. Bitcoin is decentralized. It runs on a global network of computers that no single government, bank, or corporation controls. Like gold, it has no counterparty risk if you hold your own keys. But unlike gold, Bitcoin is borderless. You can send $1 billion worth of value anywhere in the world on a Sunday night in about 10 minutes. For just a few dollars in fees, no armored trucks, no customs, no permissions. Try doing that with bars of gold, the ETF ERA. This is the massive shift for the American investor. January 2024 changed everything. The SEC finally approved spot Bitcoin ETFs. Before this, institutions struggled to buy Bitcoin. Pension funds, university endowments, even the average 401k holder couldn't easily access it, blocked by regulations, custody risk, and compliance rules. Now, the floodgates are open. BlackRock, Fidelity, the titans of American finance are actively offering Bitcoin to their clients. That single decision did more than boost price action. It legitimized Bitcoin in the eyes of Wall Street. Almost overnight, Bitcoin moved from the fringes of the internet to the core of the American financial portfolio. The downside: volatility. Bitcoin is not for the faint of heart. It has suffered 80% drawdowns, not once, but multiple times. If you need this money next month to pay your mortgage, do not put it in Bitcoin. This is not a savings account, it's not a bond, and it's not a short-term trade. Bitcoin is a long-term, high-risk, asymmetric bet on the future of money. The upside is massive, but the volatility is the price of admission, the deep comparison. So, how do they stack up head-to-head, specifically for a US investor? Let's look at 4 key metrics. 1. Performance and volatility. Gold is a slow, steady ocean liner. It preserves purchasing power over decades. Bitcoin is a SpaceX rocket. Explosive upside potential, but incredible turbulence. Over the last decade, Bitcoin has crushed gold in returns, but it demanded a price. Gut-wrenching volatility along the way. 2. Liquidity and portability. Bitcoin wins easily here. You can cross a border with $100 million in Bitcoin by memorizing 12 words. No luggage, no declarations, no metal detectors. Now try crossing a US border with $100,000 in gold bars in your suitcase. The TSA will have some questions. Bitcoin is money for the digital age. Instant, portable, weightless. Gold is money for the analog age. Physical, heavy, immovable. 3. Regulatory risk, the Uncle Sam factor. This part is crucial. The US government understands gold. The tax rules are clear. The legal framework is settled. And another outright ban, like 1933, is extremely unlikely. Gold is familiar, predictable, institutionally accepted. Bitcoin is different. It's still evolving. Yes, spot ETFs helped legitimize it. Yes, Wall Street is now involved. But regulatory clarity in the US remains murky. The SEC, the CFTC, and the IRS are still figuring out how to treat the broader crypto ecosystem. An outright US ban on Bitcoin is now highly unlikely. Institutional adoption has changed that. But punitive taxation, stricter reporting, or aggressive regulation remain real risks. Risks that simply do not exist for gold. 4. The generational divide. Ask a baby boomer what real money is. They'll say gold. Ask a millennial or Gen Z. They'll say Bitcoin. This isn't just a cultural shift, it's a capital shift. We're living through the largest generational wealth transfer in history. And as younger generations inherit trillions of dollars, capital doesn't stay neutral. It flows toward what they trust, what they understand, and what feels native to their world. That likely means money moving from traditional stores of value, like gold, into digital assets like Bitcoin. Not overnight, not all at once, but over time, generation by generation. The verdict. What should you do? So who wins the battle for your American dollars? The answer isn't either or. It depends on who you are and what you're trying to achieve. If you're nearing retirement, if wealth preservation is the priority, if you sleep better knowing you own a physical asset that has survived every empire collapse in history, gold is your foundation. A 5 to 10% allocation to gold acts as insurance against severe financial crises. But if you have a longer time horizon, 5 to 10 plus years, if you can stomach 30% drawdowns without panic selling, and if you believe the world is becoming more digital, not less, then Bitcoin offers upside potential that gold simply cannot match. One protects your wealth, the other attempts to grow it. The smartest portfolios understand the difference. The smart money approach. The smartest take? Maybe it's not versus, maybe it's and. Many modern portfolio managers argue for holding both. Gold as your defensive shield, built for storms, crashes, and survival. Bitcoin as your offensive spear, designed for growth in a digital world. Even a modest 1% to 3% allocation to Bitcoin in a traditional portfolio has historically boosted returns without blowing up the risk profile. Different assets, different weapons, but the same enemy, currency debasement. Currency. The one thing you cannot afford to do in this US economic environment is hold 100% cash. Inflation is a silent tax, quietly eating your savings alive. Whether you choose the ancient stability of gold or the digital scarcity of Bitcoin, choose something the government cannot print more of. So what's your pick for the next decade? Team gold, team Bitcoin, or both? Let me know down in the comments. I want to see the debate. If this deep dive helped you think more clearly, hit like and subscribe. We're here to help you navigate the new rules of money. Thanks for watching.